Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
You're listening to the Macro Brief, the podcast that looks at the issues driving financial markets across the globe. This episode was recorded for publication on the 23rd of October 2025 by HSBC Global Investment Research. All the disclosures and disclaimers associated with it must be viewed on the link attached to your media player. And remember to like and subscribe to the Macro Brief wherever you get your podcasts.
Hello and welcome to the Macro Brief. I'm Aline Van Dyne in New York, and today in our New York studio we're discussing the key topics from the recent IMF-World Bank meetings in Washington, D.C. Just a reminder, every year thousands of politicians, policymakers, businesses and investors meet to discuss the global economic outlook. Anything from, is the US economy going up or down? How much of a game changer is AI? Tariff pain? Has it been overestimated? Can emerging markets keep outperforming? How worried should we be about corporate defaults? To discuss this and much more, I'm joined by three of my colleagues that were right there in the center of the action in DC and in many of the conversations held there. Janet Henry, Global Chief Economist, Murat Ulgen, Global Head of Macro Strategy, and Paul Mackel, our Global Head of FX Research. Welcome, everyone. Janet, let's get right to it. What's the mood around the US economic outlook?
Well, in Washington, the mood was really quite bullish about markets and about ongoing economic resilience, because growth this year, not just in the US but globally, has been more resilient than had been feared, certainly around Liberation Day. US growth has been slower than 2024, but it's still pretty resilient. And certainly our outlook is that we are looking for things to moderate a little bit over the course of the next 6 months. We've got slower employment growth. We've still got the lagged impacts of tariffs feeding through. And so a lot of the questions are obviously about how much the Federal Reserve can cut interest rates. And we think, yes, we will get rate cuts in October and in December, but actually disagree with the market in terms of expectations for more aggressive rate cuts next year. And I think regarding the mood, a lot of discussion still coming through about the role of the fiscal stimulus, the big, beautiful bill, and the impact that will have on the income distribution skew in the US.
And so, yes, resilience, but that's despite quite a lot of uncertainty. Murat, that's something that you've been talking about quite a lot in terms of your takeaways from the IMF meetings, right?
Yes, indeed, Aline. I think this is probably the only certainty, that's uncertainty. Mm-hmm. And I mean, look, the whole week of meetings were held against the backdrop of a lot of things happening. I mean, one of which Janet has mentioned, the future direction of the US economy, but also the performance of risky assets, which has been very strong this year. Whether this will continue towards the end of the year, or whether are there any reasons that this would change. Clearly we were holding the meetings in an environment of government shutdown and data blackout, which is causing an additional layer of uncertainty. China-US tensions on tariffs, renewed tensions very recently, gold prices ripping. So lots going on. Definitely a lot of layers of uncertainty. But look, I wouldn't say the mood was generally very downbeat, especially when it comes to emerging markets.
Right.
The performance across asset classes this year has been very strong, the strongest since 2017. And clearly investors were, kind of looking for ideas and opportunities across all asset classes, and whether this can continue towards the end of the year.
Speaking of asset classes, Paul, what does all this mean for the dollar, and what kind of questions were you getting about that?
Well, that's the topical question, of course. But just to follow on from Murat's thinking, that also the turnout at the events was incredible. That was a huge turnout through the whole week, which was fantastic to see. But coming back to the question on the dollar, it was top of mind amongst investors. Like, where are we going next on this currency? And I think the reason why is because a big part of their performance was driven by the weak dollar. And of course, the dollar's fall has stalled over the last few months. I think there's still a general belief, and we would subscribe to it too, that it's not complete. There's still some further decline to come as the Fed is in its easing cycle, and we're still thinking about the backdrop for risky assets still being relatively positive. And we're also thinking about what tends to occur when the Fed is easing and when recession probabilities in the U.S. are quite low. The dollar tends to sag. So we still think that there's some innings left in this weak dollar story, but it's not going to be in perpetuity. And I think that's a very different message than perhaps some others out there.
Yeah, but it wasn't just about uncertainty, Aline. You know, the mood was surprisingly optimistic in a lot of meetings, and it wasn't just regarding emerging markets. I mean, there was still a lot of optimism regarding AI. You know, and many people in Washington saying, yes, this might be a bubble to some degree, but are still riding the wave, still really buying into the idea, not just of a demand-led improvement in AI-related spending, but also the potential productivity gains. And also in the US context, the financial sector deregulation. Very important as well.
And so the discussions around AI, is it fair to say that they've broadened beyond, you know, people looking at tech companies or the tech sector and across policymakers, across investors in a broader sense? Like, is it more of a macro discussion now?
I mean, Janet, you've been saying that this is more like a demand story at the moment, more investment demand across the board. We haven't yet seen the supply effects or productivity effects. It may take a while.
It may take a while, but, you know, if there's one thing we've learned in the space of the last 20 years regarding AI is that the impact is not linear. You know, it kind of went exponential in 2023 regarding ChatGPT. And of course, since then, we've had the China advances regarding DeepSeek. But Murat's absolutely right. Where we've seen the biggest impact so far is on the demand side. You've seen it in the Asian trade story. You know, a lot of the growth resilience so far this year on the trade side isn't just about US front loading. You've still got the AI hardware story and supply chain story playing out in Asia and parts of the emerging economies. As much as we can all point to anecdotes in certain areas where AI has led to some efficiency gains, and obviously it is perceived to have played a role in some of the rise in graduate unemployment, the fact is there's very little evidence so far of an economy-wide impact on productivity growth. Most of the academic literature suggests it's going to be an early 2030s story, but the truth is we just don't know at the moment. And the reason why it is important at the moment is that US growth is strong, but employment growth is very, very weak. And that is the big assessment that policymakers are having to make at the moment. Is it just that you can have still relatively resilient GDP growth with you know, little or no employment growth?
I mean, I was going to shift gears a little bit because the other thing that stood out for me is all the debates about fiscal, what's happening in the developed world, in France, in the UK. We haven't heard that much, neither for the US. If anything, yields have been falling. That was the background. Maybe a little bit of news from Japan. Paul, you follow it very closely. But I'm going to tie it back to the emerging markets argument because I think there is a view out there that emerging markets, the risk asset class, they performed well because they are in a relatively better shape. These are GEM strategists they publish, they're calling the good place.
So do you mean better shape from a fiscal perspective?
Yeah, the macro balances and the policy direction. And actually there is a thinking that perhaps there's a risk premium compression as, you know, emerging markets have been delivering better policy, more foreseeable, predictable and conventional, and the debt levels are lower, no major excesses, either fiscal or current account. I mean, there are obviously exceptions, but as a general broad asset class. So there was this question whether this is a compression of the risk premium vis-a-vis the developed world.
And I think that's a key point. So what it means on a forward-looking basis from the currency perspective is that it's not just going to be about a weak dollar or soft dollar that can benefit these currencies. You know, the local factors in a number of different places are on the positive side. So we could see some decoupling where, I mean, we always have to be careful using that word decoupling, but to a certain extent, these currencies can hopefully trade on more of their own merit, their local merit, rather than just a byproduct of the soft dollar.
It's interesting you mentioned decoupling because that was exactly what came to mind. Even though a strong US economy or a resilient US economy usually has a positive impact more broadly, is that actually necessary to maintain some of these positive trends that you're discussing? Or is there, like, the US its own story and the rest of the world a different story?
Well, this is one of the points that Paul's been making in some of the meetings. You know, so much of the uncertainty so far this year has weighed, until relatively recently, on the US dollar, but Paul keeps emphasising you don't forget your relatives. And that's where Japan has come up in some of those conversations, hasn't it, Paul?
Absolutely. It's not just about Japan. It's what's been going on in France and how it's been impacting the euro at times. And of course, we still got big things in front of us with the UK and sterling. So yes, I mean, through most of this year, we've just been inundated with having to digest U.S. policy uncertainty and what it means for the dollar. But we've had a very strong reminder about other issues that can impact the respective currencies.
So I need to ask you, tariffs. We probably, between us, talked about tariffs more than we ever had in the first few months of this year. Did this come up much? Is this still a pain area to come? What's the view on tariffs?
It's still a big talking point.
Okay.
But generally, most people perceive that tariffs have not had such a negative impact on inflation or on growth than perhaps they had feared. So, one of the key points I've been making is that, where we've seen the tariff impact feed through in the US already is on those products where you had tariffs imposed at the earlier stage. So on China, for instance. So if you look at the biggest increases in prices in the US, it has been in the audio equipment and some household goods and other more expensive products that did have tariffs on them coming through to the US. But you also saw a lot of front loading. So, what you had over the summer was more tariffs. We will get more tariffs on various sectors, not just later this year, but early next year. And some of those inventories that were built up earlier in the year, especially on inputs and intermediate goods, have actually been run down to some degree. So certainly we are looking for more pass-through in the coming months. But probably too much discussion on tariffs relative to the other big supply shock on the US, which is sharply lower immigration.
Right. Yeah. And I know we've written a bit about that, especially this week. I think the number of what they call border encounters, so interactions between people trying to get into the US and authorities there, is down 90% versus a year ago. So dramatic drop.
It is. And obviously, this is one of the issues that the Fed itself is grappling with. How much of the slowdown in the labour market is demand, companies not firing but not hiring either, and how much of it is, it's not just the lack of border incursions, but how many people are self-deporting. So it's really difficult to know what's happening at the moment regarding the supply side of the labour market.
But back to tariffs, the interesting thing to me, and Janet, as you always say, tariffs are a negative demand side shock for the rest of the world. And it's interesting that, that bit and also trade diversion from China, which for some countries keeping a lid on inflation, it has opened up room for many economies around the world to cut rates irrespective of the Fed. This easing cycle has been led by the